Good evening, everyone. I am Arijit Saha, a recent MBA postgraduate from the University of Burdwan. I have also qualified UGC NET in management in June 2024 edition. I am currently working with Saroj Mohan Institute of Technology, a college of Techno India group. I am currently working there as a visiting faculty in the management department. So, in today's demo or short lecture, I want to discuss about a very important topic of financial management or strategic financial management, even of corporate finance, that is capital budgeting. So,
So at first, I would like to discuss or recall what are the primary responsibilities of a manager or financial manager. The primary responsibilities of a financial manager is to take investment decisions and financing decisions. Investment decisions and financing decisions, as we all know, are very big part of financial management. And this capital budgeting falls under investment decisions or long-term investment decisions. So moving forward,
so what is capital budgeting? Capital budgeting is the decision, is the investment decision in where we decide if we should go on with this project. We set up some scenarios, we do some mathematical calculations, we find out present value of future outflows, do lot of things, lot of calculations. Then we simulate the scenarios and find out if the situation is ideal to invest in, if the project is ideal to investment, ideal for investment or not. Then only we invest in those projects. So capital budgeting is the decision toolkit for investment in big projects, long-term projects. In capital budgeting decisions, we find two types of projects: mutually exclusive projects and independent projects. Mutually exclusive projects are those, okay, in which there are a lot of alternatives, and in between those alternatives, we decide which project is the best or ideal one, which project gives us the best ROI. Then we decide or go on with that project. But in case of independent project, there is no other project associated with it. It is independent from another, or it is a single project. When company goes on a single project, uh, in case of that, there are some criteria which are set by the company itself. Then, if the criteria is fulfilled, then the project is accepted. So, coming to capital budgeting techniques or methods. The capital budgeting methods are categorized in two groups. First group is where the time value of money in cash flows are not considered. And in second group, the time value of money in cash flows are considered. So they are basically named traditional, traditional method and discounted cash flow method. In traditional method, the time value of money is not considered. And traditional, in discounted method, the time value of money is considered. Traditional method, the payback period and accounting rate of return methods falls under this traditional method where time value of money is not considered. And the NPV or net present value, profitability index, and internal rate of return. These are the methods. These are the methods which are considering the time value of money. Okay. So there are two subcategories and five subcategories of what? Of methods in capital budgeting. Some method follows the time value of money, some does not. Okay. So ideally, the ideal scenario is one, the time value of money is considered because value of the money is not same with changing time. Today's 10 rupees or today's 100 rupees is not equivalent to the 100 rupees which will be in future. For what? The phenomena known as inflation. The value of rupees falls down for the phenomena inflation. Okay. So it is a broad topic. The inflation is another topic itself. I hope that who knows financial management knows about what is inflation itself. So I will not explain the inflation phenomena here. But the discounting methods or discounted cash flow methods considers what time value of money, inflation, all. But the traditional methods does not. So traditional methods are not the ideal methods to consider for capital budgeting. The most accepted, widely accepted methods are what? Discounted cash flow method or net value method. Okay, moving on to next. So the first method of capital budgeting techniques or first method of the traditional capital budgeting technique is the payback period. The payback period follows this question that how long it will take the project to pay back initial investment. So it just considers that how long it will take to get out the money or get the investment back, which is initially invested. So for getting this, getting this number, what we do is we first keep the investment or initial investment as an variable and then divide it by the cash flow or projected cash flows that forecasted cash flows, how much will may this company earn by this project. Suppose a company has invested 1,000 rupees. Okay, a company has invested 1,000 rupees and the cash flows are of 200 rupees, 200 rupees per year. Then what will be the payback period? The payback period will be 5 years. So this is how very simple method where the variables are the initial investment, the amount of initial investment, and the projected cash flows. The projected cash income, cash flows, net incomes, whatever you say, when these two will be divided, we will get the years, projected years in which the payback period is supposed to be over. Okay, moving on, say this example of payback period. Delta Company is planning to purchase a machine known as Machine X. The machine would cost $25,000 and would have a useful life of 10 years with zero salvage value. The expected annual cash flow of the machine or annual cash inflow of the machine is $10,000. Compute the payback period of the machine and conclude whether or whether not the machine should be purchased. If the maximum desired payback period of the Delta Company is 3 years. So here criteria is given that the machine must give the return on investment in between 3 years. So criteria is given. So let's see at the solution. Since the annual cash flow inflow is even in the project, we can simply divide the investment by the annual cash flow. Compute the payback period. It's shown below. Payback period. First, the initial investment is given. So it is the initial investment divided by the cash flows. The cash flow it will generate is divided. Then what comes? The answer comes 2.5 years. So it fulfills the criteria. So as I have said, it is very easy method. The easiest method of capital budgeting. First you have to do is take out the initial investment as a variable and divide it by the inflows, cash inflow or projected cash inflow. Then you will get the projected years in which the payback periods is completed and if the criteria is given by the company, if it fulfills it, then the project should be accepted. In case of independent project, it will be done as like this. And in case of if it is uh, mutually exclusive project, then in between those alternatives, all the which uh, project would have the payback period least, it would be accepted. Okay. So coming on to the next method, average accounting return or accounting rate of return. Accounting rate of return is another basic method uh, which follows the traditional capital budgeting rules that doesn't follow the TVM or time value of money. And there is another specialty about this accounting rate of return or average accounting return method that it does not use the data, financial data from cash flows. What it does, it use accounting data on profit or from income statements. Okay, and book the value of investments. The formula is pretty basic, that average net income divided by average investment or initial investment. So I have not given any example of this method. It is pretty basic. If the sums are too basic, and the cutoff rate of this return is also given by company. Okay, and if the cutoff rate is accepted, the cutoff rate in case of mutually exclusive projects, in which the net income is highest, okay, in which the ARR is highest, it is accepted. And in case of independent projects, the cutoff rate is set by company, is projected by company. If it fulfills the criteria, fulfills the cutoff rate, then the project would be accepted. So next is the net present value, the first method of discounting cash flow method. The first technique of discounting cash flow method. This method follows the TVM, or time value of money approach. And the formula here is also pretty basic. Total present value of CFs or cash flows minus initial investment. Here is the catch. Total present value of CF. So we have to find out the present value of forecasted cash flows. Okay. Present value of forecasted cash flows, and we have to subtract it with the initial investment which is invested during the project. Okay. Which should be invested during the project. So estimating NPV, we have to first estimate the future cash flows. Okay. How much and when. Estimate the discount rate. We have to find out the present value, so we have to estimate the discount rate and estimate the initial cost behind the project. The minimum acceptance criteria is NPV if the NPV is greater than 0. And if there are mutually exclusive projects, then the project having the most NPV would be accepted. So moving on to an example. Okay, so see this question. The initial outlay of project is $1,100. Required return is 10%. Revenues are this. Okay. And these are the expenses. Okay. So what we have to do, draw a timeline to find out the present value. Okay. And find out the net present value or NPV of that project. So looking on to this solution, first the timeline is formed. It is formed by the revenues and expenses that are forecasted that it would be generated. Okay. So initial outlay or initial expenses is given here. Then revenues it might generate, it is also given. Expenses also given. Then we have to calculate the cash flows out of it. After calculating all these cash flows by subtracting expenses from the revenues, we have to also calculate the present value. We all know the present value formula, that is this one, C by 1 plus R to the power number of years. Okay, R is the rate of interest, C is cash flow, and number of years, the here 1 year or 2 year or 3 year, whatever is given. Okay, so we have to find out the present value of each cash flow. Okay, each future cash flow. After finding it out, we have to uh, add or sum all this present value of the cash flows and then subtract it with the initial outlay, which will give a NPV. It might be positive and it might be negative. If it is a positive NPV, then it should be accepted. And in case of mutually exclusive projects, the highest of NPVs, the highest of NPVs should be chosen. Okay, this was NPV, the first method of discounted cash flow methods in capital budgeting. So profitability index, it is another method of the discounted cash flow method. It follows the same. It follows the same rule, that it considers the time value of money. It is quite looks quite similar to the previous method, NPV method, but is different here that the cash inflows is divided by the cash outflows. In formula, the cash inflows are divided by the cash outflows, and the accepted rate is acceptance criteria is if the profitability index is greater than 1, and in the alternative, if there is mutual exclusive project, then the alternative with highest profitability index would be accepted. But why profitability indexed is used? Profitability index is used because in case of NPV, it is quite of something which is absolute. If we want to measure it relatively, it can't be done. Okay, it is kind of absolute. You are measuring a cash flow of a single segment or of a single project, and you are then comparing it with another cash flow of another project. So it is not quite acceptable thing. So this profitable index does what? It is used for the relative calculation. As the output it will be based on the single units, even the single units of the project. Okay. So after the output, you can compare the output comes like this 1.5, 2, 3, and in case of that NPV 3000, okay, 4300. That is, you can't compare it with another project you because the circumstances are different. But Uh, this profitability index is tailor-made like that you can compare this with another project relatively. Okay, so this is a profitability index itself. Okay, so let's see an example of profitability index. Okay, suppose uh, there are following information on project Y. Cash outflow. Sorry, it will be present value of cash outflow is not minus uh, dollar 1,100 and rate of interest 10%. Okay. Annual cash benefits first year $500, second year $1,000. It is forecasted. Okay. So first, what we have to do, we have to take out the present value or find out the present value of forecasted amount. So rate of interest is given. So here we can see I did it for ease for doing it fast. So we should find out the present value. Present value 500 divided by 1, whole bracket 2 square 1 first, then 1000 divided by 12 bracket close square 2. Okay, so the what comes after calculation, the present value will arrive, the present value of both year will arrive, we will add those two and divide it with the cash out, and the profitability index will come out. This is the profitability index and it is accepted. Why? Because it is more than 1. And if we see there is there are multiple projects and we have to choose between those multiple projects, we should choose one with the profitability index having highest number. Okay. So this is it. So I will end it here. There is another method known as internal rate of return. It is also the method of discounted cash flow capital budgeting method. It follows the time value of money approach, but I am not explaining it here because it is supposed to be a short lecture and it is already 20 minutes. And if I explain that internal rate of return method, I have to explain other methods too. I have to explain the relation between other methods. Okay, internal rate of return and NPV, which one is better? We have to compare it and all. So I am ending it here. I hope I could make you understand, and I hope my points are clear. Thank you.